5:03 on my clock too. Welcome everybody to another edition of Multifamily University Town Hall. We are at number 5, and many of you may have joined us before. And for those of you that are new, welcome to you. We are here today with two new panelists that are with us, and of course my business partner Neal Bawa. I'm going to let each of them give a brief intro of themselves, and then we've got a wonderful set of questions focused on the economy and multifamily. So I'm going to start with the guest below me, which I believe is Jay Scott.
Awesome. Thanks so much, Anna. So my name is Jay Scott, and I come from a tech background, a business background, now a real estate background. I hit on all facets. I'm more a business guy than anything. I started investing in real estate in 2008, but I wouldn't consider myself as much of a hardcore real estate investor as a lot of people. I like to run my real estate businesses like businesses, and so surround myself with smart people. We've done a few hundred flips. We've done many dozens of buy and hold deals. We've done lending, ground up development. We've done a little bit of commercial. We've done some multifamily. We've done a little bit of everything in the real estate space, as well as the business space. And I am an economics nerd. So I think tonight we'll be talking a little bit about the economy and economics and economic cycles. So thank you for having me here. I'm really looking forward to it.
You may want to mention a couple of books you wrote, plus a podcast that you host.
Thank you. I appreciate that. So my wife and I are co-hosts of the Bigger Pockets Business Podcast. Basically, we interview entrepreneurs and business experts from around the world, everything from very small startup entrepreneurs up to, we've interviewed Barbara Corcoran and Jay Papasan. So kind of hit everything in between. And I have written 4 books on real estate investing, the book on flipping houses, the book on estimating rehab costs, the book on negotiating real estate. And my most recent is called Recession-proof Real Estate Investing, which I just happened to release last April.
There you go.
Good timing.
Good timing, yes, for us.
Yeah, so hey everyone, thank you Neal and Anna for having us. Definitely appreciate it. I guess I have a similar background to Jay. So, kind of came from the tech world. I guess, started off in high school, had my own web company, did well, went to college, wanted to be bio pre-med, realized that I like problem solving more than memorization. So kind of went down the tech route, worked at Microsoft, which I believe Jay as well did the same thing. And, after Microsoft, I left to start a software company, really with a vision of building software for industries that don't have it. And so really real estate was one of the first ones. It's kind of a dated industry, really old school. And, I've since learned that the opportunity is bringing what we know from the tech world and actually using that to be more effective in real estate. And so, kind of accidentally maybe got into real estate, loved kind of the syndication model and, the business model similar to Jay. It's about building a proper scalable business. And so started Disrupt Equity with a friend and partner. And, we've since been kind of growing up from there. And, we've done about 1,700 units since then and continuing to see what's out there. And so, multifamily has been our focus, but to me, it's disrupt equity, not disrupt multifamily for a reason, right? It's really where the opportunities are.
And while you're sitting on a beach, you may want to mention something that many people know you for, which is a certain conference.
Sure. Oh, so we do have a conference that we have. We've had Neal come speak at actually, I think every single one of them. So Multifamily Investor Network. And really the vision is just about how do we put on a really high quality conference, no sales pitch, and really bring on experts such as Neal to speak about different things. And, it's really bringing the education to people. So we were supposed to be in San Francisco actually next month, but I think we've since had to cancel that one. And, we'll see if we can kind of kick off Boston again in a few months. And so that's kind of TBD.
Neal?
Yeah, you could pretty much photocopy everything that Feras said. I think we're brothers from another mother. Technologist, data scientist, love numbers. I love the power of numbers to generate profit for real estate investors. Unlike most syndicators, I also enjoy new construction projects. So half of our $265 million portfolio is new construction. The other half is value add projects, multifamily, student housing, public storage, and soon also an industrial project. And just enjoying the part of real estate that I enjoy the most is these sorts of conversations with people that are in real estate and are not afraid to be candid and not afraid to give their opinions to people straight. So I think you'll really enjoy this town hall because you've got people here that are known for being very candid with their opinions.
That's right. I'm Anna Myers. I am Vice President at Grocapitus, and I'm also a data nerd with a tech background and a third-generation commercial real estate person as well. And we are going to dig into it now. So let's start with a question for Jay Scott. How is COVID-19 upending the business cycle?
So when we talk about the business cycle, so I guess take a step back a little bit. We hear the term business cycle. Typically, the economy, things within the economy are very cyclical. And I know for any new investors out there, anybody that is on the younger side, maybe just started investing after 2008, it sort of feels like the economy goes on for a long time, does really well. We have like this past 11 years has been what we refer to as an economic expansion. But historically speaking, that's actually not the case. So if you go back about 160 years, we've had 33 recessions, 33 full economic cycles over the last 160 years. If you do the math, 160 divided by 33, what you realize is every 5 or 6 years, we have this up and down cycle, this full economic cycle. And it's been a little bit longer over the last few decades, maybe 6 or 7 years. But in general, every 6 or 7 years, you can expect that we're going to reach a peak in the economic cycle and we're going to trend down the other side. And so a lot of investors, especially a lot of new investors, don't realize this. They kind of feel like, well, we can go on, we can have economic good times for 10 or 20 years. And then if we get unlucky, we're going to have a recession. And it's actually not that way. Recessions happen and they happen regularly, and it has nothing to do with luck. It basically has to do with how our economy is run and the Federal Reserve and our central government and a whole bunch of other things. But recessions are inevitable. And so I came on with you guys, maybe it was 6 months ago or 8 months ago, and we were talking about the fact that I saw, looking at the economic data, looking at the timing characteristics of the economy, I was fairly convinced that we were kind of at the peak of the economic cycle and a recession was coming at some point soon. Now, never would have expected that we would see a COVID-19 or a pandemic, what's often referred to as a black swan event, one of these completely unpredictable events. But even without this, I think we were heading towards that inevitable downturn in the economy. And so this obviously hastened it. And so what I kind of liken this to right now is the metaphor that I use is think of the economy as it ran off a cliff and is now falling really fast towards the bottom of that cliff. Now, what's going to happen is it's not going to hit the bottom most likely. I mean, obviously there's always a risk that things kind of implode and we just see a complete economic collapse. It doesn't appear that's going to happen. What's most likely going to happen is we're going to, at some point in the next couple weeks or months, the lockdown's going to alleviate, people are going to get back to work, and it's going to sort of be like at the bottom of that canyon, the economy is going to bounce off a trampoline and it's going to bounce back up towards where it was. Now, anybody who's familiar with physics knows that when you bounce off a trampoline, you're going to lose some momentum, you're going to lose some energy, and the economy is not going to get back to where it was. It's just not going to happen. So what I think is likely to happen is in the next 2-3 months, we're likely to end up somewhere in kind of a typical recession or numbers that look like a typical recession. So a lot of people will go back to work. A lot of companies will start producing again. People will start buying again, but we're not going to be at 3.7, 3.6% unemployment like we were in January. We may be at 6, 7, 8% unemployment. GDP, the gross domestic product, or the total economic output of the country, isn't going to be at 3 or 4% where we'd love it to be. More likely, we're probably going to see a flat economic recovery, maybe a little bit negative in economic growth, we're going to see a typical recession. So the bigger question is, what happens after that? Does that typical economic recession lead into basically the next expansion where things kind of go up again and we have another 3, 4, 5, 10 years of good times? Or do they lead kind of downwards into a much worse recession or potentially even a depression? And I think there are a number of factors that will kind of determine in the 3 to 6 month mark, do things get better or worse? But we can't really predict that at this point, in my opinion.
Neal, can I have you jump in on that?
Yeah, I wanted to use an
Rubbing your
analogy here,
hands.
right? So one of the reasons that these are cycles is because if you go to your dentist, you get your teeth cleaned, and once you've cleaned your teeth, at that point, the chances that you'll get a cavity are extremely low. And that's what a recession is. It sort of cleans out all of the companies that are just barely hanging on, that are actually not strong companies. They're weak companies, but they hang on because the cycle is running. And when the recession happens, it actually has that cleaning effect on the economy. And so when the economy comes out of a recession, that's when the economy is cleanest, that's when it's strongest, that's when it's most resilient. And as time goes on, there's this tartar that's getting added on to the teeth. And as time goes on, more and more, even the smallest shock can tip the economy into a recession. In this case, you basically end up, with another cleaning. So these cycles are good for us. It is extremely necessary for the economy to go through a recession cycle so that we clean up. And the most innovative, the strongest, the most resilient, the most data-driven, the most process-driven companies are the ones that gain market share. And that's what allows economies to grow. That's what creates productivity. That's what creates wage growth. And so if the economy doesn't go through a recession for 10 or 12 years, you actually end up with an extremely poor economy. You end up with an economy where the resiliency is not a key feature of that economy. So I think we're going through that cleaning. My belief is if it wasn't COVID-19, something else, maybe less powerful, would have come along in the next 18 months and knocked us into a recession, because you eventually get to the point where you're just getting slower and slower and slower in terms of GDP growth. And so it becomes easier and easier to tip over into a recession. So that's really what's happened here. This happened to be the COVID recession, but I think would have happened in the next year and a half anyway.
Can I add one thing there? And I love that analogy about teeth cleaning. And so in your analogy, basically it's the tartar that's building up and building up and building up. In the economy, we refer to it, and Anna used the term business cycle. There's actually another name for this economic cycle that we refer to as the business cycle. We also refer to it as the short-term debt cycle. And the reason we refer to it that way is that tartar that's building up, that's eventually going to bring on the cavities and cause a lot of bad things in your mouth. In the economy, that thing that's building up is actually debt. And at the end of a recession, like going into that next expansion, think back to like 2010, 11, 12, debt was at very, very low levels. Basically, a lot of people had lost their houses. A lot of people had discharged their credit card debt. They've lost their cars. Corporations had discharged a lot of debt. Debt was at a relatively low level. Over the last 10 years, the amount of debt that consumers and businesses and the government has built up has slowly increased. And we're now at the highest levels of debt that we've seen in this country ever. And the recession is basically the cleaning of debt. The whole point, the whole reason for a recession is it gives us a chance to discharge or to get rid of a lot of that debt. And that's one of the big reasons why we see the economy cycle, because we see these debt cycles.
So one of the things I wanted to add to that is when I was thinking about what you guys were saying, I'm thinking back to 2008 and also thinking about the innovations that came out of that time period. That really changed us fundamentally, and people got creative and how to make money, and there, the whole Airbnb and Uber and Lyft and the sharing economy. There was like a mind shift that happened, and so I think that there's a lot of innovations that can come out of a recession. So the cleaning can apply not only to debt, but when things are so easy for us, like we're building, it's just easy to make money. People aren't being clever. They're not being that ingenious. So I think that a lot of good things are going to potentially come out of this as we push ourselves forward to great new ideas. And with that, I want to ask Feras, so what has this pandemic taught you about making deals, even very difficult deals, work?
That's a great question. I think really Neal hit it on the head. I'm not sure I agree with Jay about the debt part, because I think the outlook of debt is there's a lot of money out there, and there's still a lot of money out there. And I actually think the amount of money that got pumped in the economy is going to, be even more of a wealth transfer of separation, and the people that have the money are going to still place the money. And so I think on the outlook, TBD, but I love Neal's analogy, and I think that's the true part. It's that you're going to see a lot of other operators who were barely making it, running their deals super tight, everything about it, those guys aren't going to survive. And so what it's taught me is that I'm glad for the deals that we decided to go lower leverage. I love those deals. I mean, we have that much more buffer. And the other part of it too is just that, it's taught me, I guess, just how to really, be a lot more proactive with what we're doing, right? And so that's gone really well. We manage in-house, we are vertically integrated, and just seeing the things that we are doing versus what other people are struggling to try to get their property management companies to do, it's been night and day, right? Like, I mean, we've surprisingly, May so far is actually on track for a much better collection than we were in March, than we were in March. Yeah. And March was our best month ever, right? And April, was okay. But it's been interesting to see the things that we can do and adjust and kind of push. And then the other part of that too, what I've seen, at least on my side, is this is the time where all the other operators kind of disappear, right? Like, they're not talking to their brokers as often. They're just kind of waffled, right? And if we're one of the few ones that are talking to the brokers, we still are able to peek our heads above water. That's, I think it's really giving us a lot more credibility with, the other brokers, and just kind of seeing, just talking to all the brokers. I mean, it's a slaughter out there, right? Like, one of them is telling me 90% of their deals fell off, and of the remaining deals, 90% of the sellers aren't realistic. And so his example was only 4% of the deals are going forward, right? And so it's been just interesting to see, the cycle and kind of who's working through it and who's not, and, who's making a plan and who's just kind of sitting there hoping for the best. And I think that's maybe what it is. You can't just hope for the best, and really need to get out there and, identify the problem and figure out what are the plans you can do to kind of help push it along.
Well, this is a general question. I'm going to make it broader than real estate, because Jay deals with businesses outside of real estate as well. What is the best time to invest or in real estate or buy businesses, which is something that people are doing this year? When do you think is the best time for people to, come up and actually invest?
So I have been saying for the last couple months or since the pandemic, that what we saw in 2008, I talk to real estate investors all the time who say to me, I wish I was investing in 2008, 9, 10, 11. It was kind of like, it was a once in a lifetime opportunity to get into real estate and kind of make a ton of money and pick up properties really cheap and build a portfolio and really learn the business without a lot of competition. I mean, 2008 to 11 was just a really unique time for real estate. We may never have that again. But for anybody out there that's more of a general entrepreneur, or maybe they're interested in business, I have a feeling that what we're going to see in 2020, 21, and 22 is going to be the equivalent in business as what 2008 was in real estate.
Interesting.
So after this pandemic, after things start to recover a little bit, we're going to see a whole lot of businesses that don't come back. So first there are all these entrepreneurs or business owners who, number one, I've run a lot of businesses, and I've had plenty of businesses where I get to the point where I know I should be shutting the business down, but I just can't bring myself to pull the trigger. It's like, it's my baby, and I'm going to give it a couple more months and maybe I can turn things around. And I know I shouldn't be doing it, but I do it anyway. There are millions of small business owners out there that are kind of in the same boat right now. This pandemic is the thing that's going to get many hundreds of thousands of them to kind of cut bait all at one time. Yeah. Then there's all these business owners, probably millions of business owners out there who are nearing retirement, and they have a hard choice to make. Now that the pandemic is over, they can get back to business. Do they want to rebuild their business? Or if they're a year or 2 or 3 or 4 from retirement, maybe now's just the right time to sell and to get out. And then there are all these other business owners who just may find that for whatever reason, financially, psychologically, they just don't want to go back into business. They'd rather go out and get a job. They'd rather start a new business. And so between these groups of people, there are going to be literally millions of small businesses that over the next year, 2, 3 years are going to change hands or will potentially change hands. There are a lot of business owners. 90% of businesses don't change hands. So business owners just decide, I can't make this work, and they shut their business down. But many of those businesses are viable. Many of those businesses are making money. The business owners just don't realize that there's an opportunity to sell the business or pass the business on. And if you're a business, if you're an entrepreneur and you're looking for businesses now is a fantastic time to start approaching business owners and saying, hey, your business was making money before, you may not want to start up again, but how about if I take that business over for you? How about if I maintain some continuity for your employees? How about if you hold a note and I'll pay you monthly for the next 2 or 5 years? So you're getting something out of your business. I'm getting a business that was working before this pandemic and shouldn't be too hard to get working again. There's going to be a lot of opportunities for entrepreneurs to be taking over small businesses for pennies on the dollar, just like we did with real estate back in 2008.
I completely agree with that. I was talking to my partner about the same thing. There's a lot of business out there that were just not cash rich and they're just tired of it. And I think there's going to be an opportunity to really be private, like a private equity firm, right? And I think, Jay, you're talking about the example of I'm going to go buy one business, but to me, what's even more interesting is what are the different industries or that are struggling, right? And how do you really start to glom them? And your value add is really how do you streamline them all, right? And make them that much more efficient by pulling them together, right? And pulling resources. And so it's definitely an idea that's been spinning in the back of my head.
Yeah, it's interesting that all of us are thinking the same thing. Earlier today, around 4 or 5 hours ago, I reached out to Anna randomly and I said that we need to start buying businesses. And I want to answer Anna's question in a very specific way. The right time to buy a business is at the point of maximum pain. And I'm going to describe a recent point of maximum pain. About 15 days ago, for roughly 4 hours, the price of oil for the US, West Texas Intermediate, which is called WTI, fell below zero. It fell to $37. And when that happened, I thought that was the point of maximum pain, because there is fundamentally no way at all that the world that oil should be priced below zero, because the world needs 95 million barrels. And obviously for these months, it didn't, but it's going to go back very quickly to needing 95 million barrels of oil. I knew that because China is now consuming 96% of the oil that they were consuming in December, right? That's how quickly oil demand ramps back up. So guess what I did on that day? I bought Chevron and Exxon, which are the most well-capitalized oil companies in the world, these two, right? So I bought both of them. And as you can imagine, within 24 hours, that stock went up. So buying a business happens at the point of maximum pain. But that's where you need courage, because at that point, that's when you're thinking that everyone's going to die. And the answer is no, it's not. In a business cycle, at the point of maximum pain, there's an extremely high statistical likelihood that you're going to go up from that point, not go down.
Yep. And one of the things I'm a big proponent, I've been telling people this for a couple of years now, if you're going to buy a business that's recession resistant.
Yep.
So buy a business that's going to do well, whether we're in good economic times or bad economic times, because I started a business in January. And one of the 4 main reasons that I had for starting a business or a particular business was it had to be recession resistant. Mm-hmm. And so expecting that, not this exactly, but expecting that we were likely headed towards a downturn, I made sure that business was recession resistant. And over the last 3 months, we've been hiring. We have more employees now than we had at the beginning of the pandemic, because we're a business that is recession resistant. It deals in emergencies, and the people that pay us are insurance companies, not homeowners. So the money is always going to be there. So what I would tell anybody that's concerned about is now a good time to buy a business, think about whether that business is going to be recession resistant. And if so, you've kind of got that built-in buffer of safety.
How do you recommend researching businesses that are recession resistant, and how do you find businesses that are in a finance crunch? How do you go about finding those?
So, I mean, it boils down to there are certain services that are going to be needed whether the economy is good or whether the economy is bad. So if you're a plumber, plumbers are going to have work whether the economy is good or the economy is bad. When a toilet clogs up, Nobody's going to say, I'm going to wait 2 years until I get a better job before I fix my clogged toilet. And there are a lot of these businesses that are they're services that are needed no matter whether the economy is good or bad. And so a lot of them actually fall into the service businesses in the real estate world. And so that's another one. So recession resistance, one of my
property manager. There you go, Feras.
Yeah.
No, I mean, I'll let Jay finish up his thought. I definitely have a bunch to think about.
There you go.
Yeah. But the second of the four things that I look for in a business is that it kind of meshes well into my core competencies and my other businesses. So anything in the real estate services field tends to be recession resistant, and it also meshes well with the other stuff that I'm doing. So I basically get the economies of scale. So I'm a big fan of real estate service businesses, plumbers, electricians, HVAC companies. A couple months ago, I started a fire, water, mold remediation business. These are all businesses that will tend to do well even during a recession because the services are needed even during a downturn.
I want to be very specific in my tip. It's a very short one, and I'll yield to Feras. The best way that I know of knowing which businesses are doing well at any given point of time is by looking at job ads on monster.com, on Craigslist, and making lists of those and putting them in categories. So you basically look at, you look at 200 or 300 job ads, you eliminate the large companies because large companies, you can just invest in their stock, right? So you look at the smaller companies and you look at who's hiring. And I can guarantee 2 hours of research, you're going to see very clear patterns. The patterns are different for each recession, by the way. So every time there's a recession, you're going to see a completely different bucket of companies that are needing to hire. And that sector at that point has incredible momentum. And I'm a great believer that momentum drives success more than anything else, right? So if you're seeing everyone fighting for labor, that area has much more demand than they have supply. And you might have a short 6 to 12 month window. I wouldn't go out at that point in time and start that business. I'd buy one because the momentum might be gone if I spend 6 months setting it up.
Yeah, I think that's a great example. And I think, Anna, to answer your question, I mean, I think the government's helped everyone realize what's a recession-proof business, right? All these essential businesses that you are hearing about.
That is true.
Right?
Check the essential list. That's a good point.
That's a good start. But I mean, I think I really like Jay's example because that's really how we've looked at it, right? With the acquisition side, we know acquisitions are going to slow down. We're still underwriting, looking at things. But we've known that, hey, that's, that is very much a cyclical business. And so timing might have worked out in our favor, but we've been very proactive with building out other businesses kind of related to what we have, right? We are a real estate company, but we also have a big marketing audience. And so we've been very much looking at what else can we pipe into that is more, more recession proof. And so really property management is a good one, but another one, insurance is really interesting. So if you look at any property's P&L, what are all of the items that we didn't trim back, right? All the items that we still have on the expense side. Every one of those businesses is pretty much a recession-proof business, I'd say, right? It's not, some things you can trim back, but other things you can't trim back. And so we've been really kind of looking at that and figuring out, how do we continue to basically, have more of those line items on things that we are involved in. And I think to Neal's point, I completely agree. Do not start a business from scratch because it's an uphill battle. You're already getting the discount today. That's the value, right? You're already getting that price point. Find an expert. Really, I love businesses where I can find a trusted expert that is there. And I like to put basically just a rocket on their back, right? And kind of help them.
I love that.
So find a person that is the expert. I'm not going to be the expert plumber. I'm not going to be the expert landscaper, but find the right person where there's a good fit and structure a win-win situation, right? But really help them, enable them, and, kind of really grow that business. And so those are the kind of things I think that are really attractive right now in terms of opportunities.
Well, let's bring it back to real estate because we have a lot of real estate investors on here. And let's talk about what are the resilient asset classes that people should be looking at as we move forward.
I'll kick that off. I think I've talked to Neal about this one and I think the thing we're going to see after all said and done, people are going to realize that Chili's pad site that was trading for a 4 cap does not have to be in business. Whereas multifamily, people do still have to live somewhere, right? And the government is very supportive of that, as we've seen, right? And so I think even if the economy completely falls over, the government's going to help enable that. So I think, multifamily is probably the obvious one, right? People still need to live somewhere. And I think
they'll have to shelter in place somewhere.
Yeah, and I think across the board, cap rates might, decompress slightly, but I think once things said and done, I think cap rates will start to compress. because I think there's still so much money out there if people are interested. So, I think multifamily is the obvious one, and I'll let Neal and Jay kind of say the next ones if they had any other specifics.
Yeah, I kind of see two categories here. So there's the asset classes that historically typically tend to do well. So typically buy and hold does well in any part of the economic cycle. That said, we tend to see more rent compression in the A class and the B class units, meaning if you're in a really nice apartment complex with those fantastic amenities, the Starbucks and the big gym and the big pool, a lot of times you're going to see people that they're either getting scaled back at their job, they're losing their job, they're having their wages cut, and they decide, I need to save some money. So they move from that A class unit down to a B class unit. A lot of times people in the B plus class units move down to the B minus class units. A lot of times people in the B minus class units move down to the C class units. But everybody needs a place to live. So typically the higher the class of unit, the bigger the potential rent drop. And even that said, in a lot of places in 2008 around the country, we didn't see rent drops even in the A class. In some places, we saw bigger rent drops. They tended to be bigger in the A and the B class. But if you're going to focus on, or if you want to focus on the most recession-resistant asset classes, focus on the C classes of property in any category. So I love C-class multifamily. I love C-class single family. Mobile homes. Mobile home parks are a great investment. Another thing we tend to see during a downturn is that because people are moving from bigger apartments or bigger houses to smaller apartments or smaller houses, they don't like to get rid of their stuff. They're going to keep their stuff. What do they do with their stuff? They put them in storage. So self-storage tends to do very well during an economic downturn. In the commercial world, there are certain parts of commercial that historically have tended to do well. So if you're in the retail space or you like strip centers, find something that's grocery anchored, meaning it has a grocery store as part of the space. People still need food, and people are going to go out and they're going to go to the food store. They may not go to a lot of places, but they're going to go to the food store. And while they're there, they're going to go to the stores around the food store. Medical centers, again, and one of those essentials that people aren't going to say, I've got this lump, I'm going to wait till I get a better job before I get it checked out. People are going to go and keep dealing with their healthcare stuff. So medical centers tend to do very well. Historically, maybe not this time around, this was obviously an exception, but historically college rentals do very well during a downturn because when people lose their jobs, a lot of them go back to school and they need a place to live. So obviously it's a little bit different this time because we have a lot of campuses that are closed, but historically college rentals tend to do well. So those are the things.
Campuses can be a different thing though, Jay, because certain types of students, you have to have the labs and the physical classes.
Absolutely.
So if you are going towards student, think about the types of colleges or education that require some amount of physical participation and ideally are in markets that have a more control over the corona outbreak. So I think it still can be a viable solution.
Absolutely.
Yeah, Jay's list was so comprehensive. I only have one more to add to that. He checked off all of my boxes. The one asset class that I believe is going to outperform in the next 5 years is industrial with logistics. So we have just disproven the way that this country works. We are a just-in-time economy, a JIT economy that basically has 4 days of food and 5 days of toilet paper and 6 days of hand sanitizer. And now we've realized how foolhardy that was. And I think, especially when it comes to storing, medical supplies, we are going to need a lot more space. So that itself, I think we're going to go to from a just-in-time 4-day economy to more of a 14-day economy. And that itself is hundreds of millions, if not billions of square feet of space. We've seen that every single firm that was a logistics firm for internet saw a boom. So from DoorDash to Amazon, every one of these companies saw a massive spike, right? And so you've got millions of new prime customers that now are getting used to using the internet. You've got millions of older customers who no longer were able to go to the store, that were forced to learn how to use the internet. So that's a boom. We saw in 2001, immediately following 2001, we saw that IT security was the biggest thing, right? Because people were so fearful with the terrorist attack. I believe that it's industrial with logistics, and that those are two different categories. So there's industrial, and then there's an industrial with logistics where there's an office component, and there's these ramps that you can take a truck all the way down and quickly load it up. So, and you've got the right kind of equipment inside to load those trucks. Industrial with logistics is going to massively outperform.
I love that. I love that. And here's the other thing to keep in mind. So these are all the typical asset classes that tend to do well, including, and then you have the addition of that Neal just said. But here's the other thing to think about. The best way to make money in real estate is to foreshadow, to predict where the trends are headed, not necessarily where they are, where they've been, not necessarily what's historically performed well in a recession. Because if I know that these asset classes, and Neal and Feras and Anna know that these asset classes have performed well in recessions, there are millions of other people that know as well. So where can we get a leg up on everybody else? What are some of these trends that we can predict based on what we're seeing with this pandemic? So for example, we know that retail is going to take a major hit. They're going to be, so malls were dying before this, but this could be the final nail in the coffin for malls. Same with a lot of strip centers, same with a lot of other retail. So what's going to happen with the malls? What's going to happen with the strip centers? We're already starting to see some developers come in and take malls and turn them into apartments.
And self-storage.
And does anyone have an actual example of that? Because I've heard of that. I want to see pictures and see what this looks like. I haven't actually seen that. So
there is one in Utah, I think is the first one that they're getting ready to finish up, and I haven't seen pictures yet. But basically they got approval, they got zoning, and they've been building it out. Yeah. And so and then there are going to be other things. So here's something to think about. What is the impact on families going to be from this pandemic? So there's some things we don't know yet. For example, there are a lot of people who think that in 9 months, we're going to see a whole lot of new kids being born because there are a lot of people that are locked up with their spouses and significant others. But then there are other people who have the idea that for the last 2 or 3 months, people haven't been able to get married. So a lot of people are holding off getting married. And a lot of times people that aren't married don't want to have kids until they're married. So it's very possible that we actually see a drop in the number of children that are born in 9 months. Here's the other thing.
I think it's a state by state thing.
Absolutely. and that's absolutely. And then you look at the divorce trends in China when they open back up.
Oh, so interesting, right?
I have lived and worked side by side with my wife for 12 years. We get along better than most people in the world. And let me tell you something. The last 6 weeks have been really challenging. It's put a lot of pressure on us. And if it's getting to us, you can just imagine typical couples that aren't used to seeing each other for 6, 8, 15 hours a day. There's going to be a lot of divorces in the coming 6 to 12 months. And when that happens, or at least separations, when that happens, what are people going to do? They're going to downsize. People are going to have to move into apartments. People are going to have to sell their houses and move into smaller houses. So I wouldn't be surprised if we see this trend of downsizing in residential units over the next 12 to 24 months, simply because families are likely to be falling apart based on all the time people are spending together. And there are all these different types of trends that you can probably, if you sit down and really think about it and play out scenarios in your head, that you can forecast things changing, whether it's the real estate world or the hospitality world or the business world over the next 12 to 24 months, that if you're really creative and you're a risk taker, there's a lot of opportunity.
Well, I love that, but I wanted, so Neal, do you want to tap on that? Because I wanted
just a couple more, because there's so many great ideas that are coming from this. One is, you can also use the blood in the water theory here. So I think that there's going to be blood in the water for hotels in Q4. So they're going to run out of money. Some of these will never recover. The best thing you can convert a hotel, especially a long-term stay hotel to, is senior housing. Now you might say, wait a minute, I don't want to convert to senior housing right now because that's also hit very hard. But if you believe that a vaccine comes by Q1 next year, then in Q4, when you buy a hotel, it's going to take you 1 year to convert that hotel to senior housing, which is a lot quicker than building it from scratch and a lot cheaper than building it from scratch. You've got plumbing in every single room. So you've got low-cost new hotels that are going to go out of business, and you can buy these and spend 9 months to convert them. And I think for sure we're going to have a vaccine 18 months from now, and guess who's going to get it first? The older people. So then that demographic trends, they're not going anywhere. You know, we are an aging society. Now you have an incredible asset that you purchase at a very low cost, and instead of a 30-month, fill up, you had a 12-month process. I mean, that in my mind is a phenomenal business plan.
Yeah, we do. I think that is very important to be looking at the time frame, the potential time frame related to this. And one thing we do a lot is like Neal referred to, like looking at China and looking at evidence of how they're opening up and you know what are the possibilities coming forward. But I want to bring it back to Jay was talking about families changing, and I know as an asset manager for our properties, we have seen first of all, people are staying in place. So the people that were going to leave are staying in place. That's not unexpected. But what was unexpected is how many new leases we're getting. All of these people are coming. I'm like, where are they coming from? And I'm thinking, I don't know if I'm right or not, because I don't have the data to prove it, that people are like sick of sheltering in place for the person they're with. And they're like, I got to get out of here. I'm going to go rent an apartment.
Is that
what do you think, Feras?
Or is it that the other properties aren't leasing? No, I've been wondering the same thing because we've actually seen, I track all this stuff. And Neal, I got to show you the BI dashboard of one site one day, but it's awesome. But we've been wondering the same thing. And my theories have been either that other properties are closed and they're just not leasing and they're just not being very proactive. And therefore, because we are leasing, we do have a plan that we are attracting more people than we would otherwise. But your theory is just as good as mine. I need to probably include, a questionnaire about what brings you here besides
what brings you here.
Yeah.
That's been puzzling.
Why are you meeting now?
No, because we've seen more than we expected, and it's nuts. Like
it's bizarre.
Like 7 leases a week, and we're just like, really?
How's that happen? Yeah.
Like
there's a trend. I don't know what causes it.
Yeah. So for us, let's talk about collections. We got a lot of questions about collections. So where do you think collections, what are they looking like in May? If you could give us some numbers, because people are saying, we heard what he said, and now we want some numbers. We want some statistics, man. What do they look like in April? What do you think about May, and what do you think about June?
I could have pulled up a chart had I known. So, honestly, for us, March was really our best month at probably most of our properties. So there was already a very high bar for a set. April, it was interesting. It started off good. Started off worse, but then we pretty much closed the gap. And some deals, they trended exactly the same, right? And so most of our assets are CB minus, right? That is our space. And
CB minus. And what state are you in? Can you tell us?
We're in Texas and Georgia.
Okay.
And really, we did not see much of a difference between the two. So I kind of treat them as one set of data. But in general, people paid, right? And we were surprised. And even May, I expected May to be the bad month, but actually we're ahead of March, which doesn't make sense to me. So my theories on that is
it's been bizarre for us too. It's like May was not, how could May be better than April? It doesn't make any sense.
At this point of the month are even better than April's were. And yeah, we had very little impact overall our portfolio. We still had assets that collected 100%. Zero delinquency.
Well, we had an asset collect more. it didn't make
more than 100%. Well, if you're collecting,
and that was with a high bar, right? And it wasn't like a big, deep value-add lease up. It was just a regular deal that was already stabilized. And so it's been interesting. And I think for me, I expected, because in March you got to think about it. People still work the first 2 weeks. People have a little bit of savings. They have that money comes in, right? They work for that 2 weeks. They got the 2 paycheck later. And so I didn't expect April to be too bad. And April went well. Like pretty much. We were with, on our deals, I think I want to say we were like one of them 102%, the other one 99%, 97%, and 95 of what we collected in March. So pretty much trending to March. And then the bottom one was about 91, I think is where 92% is what we collected. And that was a deal that we were still kind of cleaning up anyways. And,
right.
May though, we're literally 10% ahead of what we've collected at that point in time in March. And so I expected people run out of money throughout April, but I guess the stimulus checks and unemployments kick in. And so people are getting proactive. And I've talked to other operators where they've had some tenants come in and pay 3 months of rent. They just want to get that out of the way with this, drop their full stimulus check, the entire thing. And now they know that they're good for the next few months. And so collections, I was more nervous a few weeks ago, but especially like looking at the numbers today, and I was like, man, I might pull it up a little bit later, but very much May has gone better than March. So
let's talk about property management in general. What kind of tools and technologies do you think are useful in reimagining property management? So what would you use going forward, knowing what you know now, and you're dealing with the pandemic, you've got all this new communication. What do you suggest for property managers in this time going forward?
Okay, I think that's a good question. So whenever we start our property management company, my goal was very much to rethink property management. I think it's a very broken business for a lot of reasons. And, from transparency to communication, et cetera. And so, I've run it more like a tech company that happens to do management, right? And so having a remote company that all of our managers know how to use Zoom, they're all on Slack, they're all on Asana, having these simple tools where they just know how to operate remotely and keep everyone accountable has been significant, right? I think the other thing that I'm not fully sold on, you know, the whole concept of virtual tours, right? I mean, that helps, but I think it's more about how do you kind of set up a system and a workflow for tenants and managers to be able to interact remotely, right? Because even from the tenant's perspective, we put together, you know, we use Confluence and we push that out to all of our tenants as a resource, right? Where we're storing, you know, and for those that don't know, Confluence is pretty much like an internal Wikipedia, but we have a public version for us and our managers to be able to share resources with the maintenance, with the tenants, et cetera. And so really being a little bit more, you know, smart about how you're communicating all that. And then the other thing too is making sure we have a very clear text and phone number plan for every single tenant. Like I had them go through and figure out any tenant we did not have their actual cell phone on file, have that, right? And again, it's giving them that access. And then there's some of the obvious, right? Does the tenant have a portal to go to that they can file tickets, do things like that? And so I think a lot of the tools have always been there. It's that a lot of these companies are very slow to adopt. And so some of those companies are being forced to adopt that. And that's not just specific to property management. I think that's just a blanket statement across the ecosystem. But, you know, having those have just let us really keep humming along. I mean, regardless of kind of where things are at now.
Okay, I'm going to let Neal and Jay geek out on the economy a little bit here before we go to questions. What do you guys think we're looking at? Just speculate with me here. GDP, you know, unemployment. What are we looking at for, and I'm not talking about months from now, I'm saying, put it on the line. What are you thinking for, you know, late May, June?
So GDP is a quarterly number for the,
for GDP quarter,
so
next quarter.
It's kind of hard to do that on a monthly basis. Go ahead.
Right, so, okay, do the next quarter GDP. What do you see for that? And then what do you see for some of the monthly numbers related to unemployment?
Well, it's funny because as the guy that likes to geek out over the numbers, you'll probably be surprised to hear me say this, but my take is I don't care and it doesn't matter. What we're seeing now is artificial. The numbers are pretty much meaningless. Doesn't matter if the unemployment number is coming out tomorrow for April. Doesn't matter if it's 4% or 40% unemployment. We all know what's going on, and that number doesn't change anything that's happening. It's not an indication of where we're headed. It's not an indication of where we've been. It's simply a reflection of this artificial constraint in the workforce right now. And same with GDP in Q2. GDP in Q2 could be -3%, -5%, -12%, -20%. We don't know. But again, I don't think it's going to be indicative of what's to come or what happened in the past. It's just going to be indicative of this really strange, unprecedented event that at some point is going to end and everything is going to get better. Not going to get as good as it was. Don't think we're getting back to where we were in 2019 or 2016, but it's going to get better than where it is today. It'll get back to steady state. So I'm telling people that I'm not even looking at the numbers because it's real easy to look at the numbers and say, oh, this political party is doing a good job. This political party is doing a bad job. This has been screwed up. This has been handled well. It really doesn't matter. And there's nothing that anybody's going to do or could do to change those numbers. So it really doesn't even matter to me. I'm not saying to others, but to me, it just doesn't matter.
Well, here's where we don't agree. So I wish I could be as bullish as Jay on this. I am seeing an enormous amount of irreversible damage to the economy. I do not believe that there will be a trampoline style bounce back. I see a checkmark type economy where you went sharp down. There's no kind of bottom dwelling. So you start going back up, but when you're going back up at a completely different cadence. And I think it takes us 2 years to get back up. When I see Nordstrom going out of business, Nordstrom was not going out of business in March, but today they were a weak company. They were just barely moving along. They're going out of business. I see oil companies going out of business. I see 400 oil wells capped in the United States. The cost of uncapping those wells is extremely high. Some of those companies will take 9 months to go through bankruptcy. That's going to hurt the economy. As I'm looking at different sectors of the economy, what I see is that there's real damage being done, and that real damage is far greater than most people are telling us. So my number for Q2 is not 12% of GDP. I think we're going to GDP is going to drop by between 20 and 25% for Q2, which is insane, right? Because 2008, what the highest number was 8%, right? We're going to drop 25%. But as Jay said, that number really doesn't matter because one quarter GDP is not something that anybody looks at. You don't even call a recession based on one quarter, even though we would technically be in a recession because Q1 came in at number -4. So, but what matters is Q3. Q3 is all important. And I do not believe that Q3 is going to be as good as we believe it is, because the damage that we're inflicting, A, on the economy, and both B, on people psychologically and their ability to spend, I believe is significantly greater than what we're giving people credit for. And how do I know that? Because I'm looking at how much oil, how much gasoline are Chinese consumers spending? How much money, how many Coach bags are they buying? Are they buying Apple MacBooks? And I can tell you, the Chinese economy, even though it's fully recovered at this point, they have no restriction whatsoever. They appear to be an 85% economy. And I can tell you, if the United States recovers as an 85% economy or even a 90% economy, that is an extraordinarily sharp recession. We did not see that in 2008. I think we're going to see that in Q3, which is why I believe real estate prices will fall. A lot of people are asking questions in the Q&A. I think all prices will fall, including multifamily, including single family. We've seen severe restrictions placed by Fannie Mae and Freddie Mac on lending, and those restrictions are going to hurt cap rates. So in my mind, it's definitely, you're going to see that damage become more obvious. When Lyft lays off 1,400 people, they are not going to bring those people back in the next 6 months. When Uber lays off 25% of their workforce, Airbnb lays off 25% of their workforce, those people are not coming back anytime soon. In my mind, those 33 million jobs that we've lost, a certain percentage of them will come back, but they'll come back slower than we think. And then there's 20% or 30% of these jobs that won't come back for years. And so in my mind, this is not a Q1, Q2, Q3 recession. I think it's deeper than that. That's my feedback.
And I want to add to that because it's funny. You're the first person that's ever referred to me as bullish. Well, at least in the last few months. So let me go a little bit deeper into my thoughts because I think we agree very, very much. I think that once the lockdown ends, we're going to see that rubber band effect. I think there's going to be some optimism. People are just going to be excited to get out. They're going to be excited to go to restaurants again. They're going to be excited to spend some money, to maybe go to movies if they're open. And so I think we're going to get back to zero GDP, -1%, -2% GDP. I think we're going to get back to 7, 8, 9% unemployment. Not good numbers, but good compared to what we're seeing right now. And I think we're going to be there for maybe a quarter. So we might see this through Q3 where the numbers are typical recession numbers. Now, I by no means am bullish because I think what happens after Q3, there are 3 risks I see right now, 3 to 6 months out, and then potentially years out after that. Number one, leading into this whole pandemic, downturn, recession, there were a number of economic indicators that were concerning. So again, consumer debt, all-time high, corporate debt, all-time high, manufacturing was struggling, retail was kind of starting to turn and struggle, interest rates at 0%. So there's no leeway or runway for the Fed to kind of spur the economy. If any of those things like debt or manufacturing or anything just kind of breaks down, it can lead to a cascade, ripple, domino effect that kind of takes a whole bunch of other industries with it. So number one is just things weren't that great, in my opinion, leading into this. They weren't horrible, but they weren't as great as a lot of people thought. And so all the things that could have potentially broken had the pandemic not happened can still potentially break and domino and become really bad. That's the first thing. Number two, we've already seen between the mortgage industry, the servicing industry, oil, we've already seen some unintended consequences of government's actions and the pandemic. When the government's infusing $2 trillion, $3 trillion, $5 trillion, it might get up to $7 or $10 trillion into the economy. This is unprecedented. We've never seen anything like this before. What happens? What does that break? We have no idea. Here's the funny thing about oil. We look back on negative crude oil numbers from last week or 2 weeks ago, And it's obvious what happened. Anybody could have predicted it. Nobody predicted it. So
That's right.
So it's so logical when you saw it play out, but nobody predicted it. What are the other 1 or 2 or 5 or 10 things that are going to be so obvious when it happens that we're not expecting and that can completely derail or collapse our economy? That's because we're throwing so much money, because we're doing forbearances, because we're monetizing assets, the Fed's monetizing assets. What are all these other unintended consequences? So that's the number 2 huge risk I see. And then the number 3 huge risk is that I'm talking, you're talking, we're all talking about how this lockdown is going to end in a couple weeks or a month or 2. But let's be realistic. There's going to be a second wave of lockdowns. There's going to be a third. There's going to be waves of lockdown until we have a vaccine, which could easily be 12 or 18 or 24 months. So depending on how bad those waves are, depending on how bad those lockdowns are, that's the third big risk.
Yeah.
Between those 3 big risks, I really think that there is a possibility that what we're going to see is as bad or worse than the last Great Depression.
Nice save there. Nice save there, Jay. But I want to add
I've
more
written
risk.
about this for the last 2 months.
Okay, one more risk, and then we got to go to questions.
One more risk. I think that there are state and municipalities that were an inch from bankruptcy before this started.
Yep.
You're going to see a cascade of state and municipality bankruptcies. My number 1 candidate is the state of Illinois. My number 2 candidate is the state of Michigan. But there's so many municipalities, muni bonds. And 2008 started as a real estate recession. Then it turned into a banking recession. Then it turned into a liquidity crunch. And I don't think that we fully understand the knock-on effects. We don't understand the chain and cascade effects of this, because this has moved so quickly that we haven't had time to see the cascades yet. And I think the stock market is not giving that enough weightage, that there's going to be a cascade effect here for businesses that have just been devastated.
Here's the other thing. You look back 4 months and we had a trade war going on with China. Nobody's talking about that trade war anymore, but we saw the real life economic impacts of that trade war. Businesses were suffering. Farmers were suffering. What do you think this next wave of contention with China is going to make it's going to make that trade war look like it was 2 little boys fighting over
They're starting to talk about it today, actually. So I think there's this new thing with basically China's not buying as much as they initially promised. So you're going to start to hear more from it, Jack.
I think that's going to get worse. Now, it is the 1 hour time frame. So we do something at the 1 hour time frame that I want to invite you to do. I'd like, I'm going to ask Jay to tell us where he hangs his hat. So there's, these 434 people. If they want to follow you, what is the easiest way for them to follow you? And then I want Feras to do the same. Jay.
Cool. So please check out the Bigger Pockets Business Podcast. Even if you're not a business entrepreneur, if you're a real estate investor, you are a business owner.
That's right.
Real estate's a business. So check out the Bigger Pockets Business Podcast that my wife and I co-host. I promise you'll learn a lot.
I love it. I listen to it all the time.
Thank you, Anna. I appreciate that. Facebook, J. Scott Investor. I write about random economic thoughts all the time. Instagram, jscott_123flip. And if you want to send me an email, the letter J at jscott.com.
Perfect. Feras.
All right. So for me, feel free to send me an email, Feras, Feras @disruptequity.com. Definitely look me up on LinkedIn. Feras Moussa is my last name, Moussa. As well as Facebook. Definitely a good way to get a hold of me. And then also I am on Instagram. I'm still figuring that one out. But Feras.Moussa, and that's it.
Fantastic. All right, Anna, back to you.
Okay, so we've got a lot of questions here, and as I start answering them, people start pouring more in. So I'd like you to keep them short. We got to keep the answers short so we can get through more questions. So what do you think about inflation due to trillions on stimulus?
That's the $1 billion question. $1 trillion question.
How about I give him a short answer, right? So it's going to affect us. We're going to see inflation. I don't believe that you can see inflation during weak times. That's what we've learned from 2008. I think inflation is not a factor in the next 2 to 3 years, and then it becomes a much larger factor than it has been in the past.
I 100% agree. And yeah, we don't have to worry about inflation short term. Long term, it's a bigger issue. But I think currency in general is going to be a potential, and we don't have time, I don't think, to get into it here, but I would say risks around currency is going to be huge over the next few years. So not just inflation, but other currency risks as well.
I agree to all that. And I think the other thing to add to that is just there's going to be an interesting divide of wealth that's going to start to happen for all that money too. So what does that lead to, right?
Right.
This one's for Neal. If multifamily prices will fall, how will that play out with the new multifamily investments you are doing?
Luckily, I'm not delivering at this point of time. I expect that while I forecast multifamily prices to fall, I also expect that multifamily recovery will be much faster. Look at the outperformance in April. Look at the outperformance in May. Multifamily is a very strong sector. Really, at this point, there's no reason for multifamily prices to fall except for external stimuli. What is that stimuli? Fannie Mae and Freddie Mac forcing us to hold 12 months of impound. They're cutting our LTVs. I don't think that goes on for more than 6 months. It didn't even happen in 2008, and that was a real estate recession. So in my mind, when that external stimulus or downward stimulus, that downward pressure is taken off of multifamily, I believe it goes back up. I'm delivering properties late next year. I'm delivering properties the year after that. In my mind, I skip this mess. And so I'm very bullish. In the short run, when you pump trillions of dollars into the economy, hard assets do better, not worse, though they will slump when you have this kind of unemployment. You get through that phase, you actually have a better, a lower cap rate, not a higher cap rate.
And Anna, can I share my screen for 1 second? I pulled up the data really quick to show you.
Yeah.
I think the audience might really like it. But I gave them random names so no one can point to a specific thing. But these are just four of the assets, right, that come along. And, if you look at it really closely, right, so the blue is March, April, and then the gray is May. And if you look at what's going on in May, right, this one, I think the data was bad. They just didn't make the deposit, but it actually is sitting above March. I double checked that. And here you can kind of see, so I thought we front loaded April because we provided incentives for people to pay early, right? You can kind of see that in the data, right? And kind of what's going on. But, really on all three assets, we closed out this one above, this one, a little bit of a gap, and this one, pretty much all the same, right? And then it's been interesting to see what's happening with May. So I was talking about it earlier and I pulled it up while you guys were kind of nerding out on the economy.
Yeah, okay. I think it's just an artificial decline in multifamily, and I think it's fairly short. That's my take.
Let's see. Do you think that there's a major risk with utilizing the BRRRR strategy now, specifically with regards to being able to refinance 6 months down the line?
I am telling anybody that is planning to do a BRRRR, now's still a good time to do a BRRRR, as long as you have a plan B and a plan C for if your plan A to refinance doesn't pan out. So what I recommend to anybody that's doing a BRRRR right now, go talk to the person that's doing your primary loan, that's giving you your bridge loan, that 6 or 12 month loan so you can get to the refinance, and say to them, hey, if for some reason I can't get this refinance in 6 or 12 months, can we work something out? I make loans to investors now for BRRRR properties, and I've gone to all my investors and I've said, look, if you can't refinance, as long as you got a tenant in there, as long as you're making payments, we can extend this as long as you want. I'm happy to take the cash flow for 2 or 3 or 5 years until you can refi. So go talk to your lender and then have a plan C and a plan D. So maybe family and friends, maybe credit cards, maybe a home equity line or a line of credit. So as long as you have a backup plan for what you're going to do if you can't get your refinance through a GSE or some other portfolio lender, as long as you have a backup plan, I still think BRRRRs are a great strategy.
Okay, great. Hashtag cancel rent, hashtag no rent. What do you think about this? This person's properties are only down about 14% in April and May.
If you're in a blue state, it's going to happen. I believe that rent strikes are going to happen. San Jose is voting on a rent strike, which shocks me that Silicon Valley would even consider doing that. They're actually voting on one next week. There's just too much of this. So it happens. In my mind, blue states do it. Red states are going to quash it. There's going to be a massive amount of political resistance to it. So I would be very surprised that if red states do it. I think with blue states, you've seen it coming already. They're going rent control anyway, right? New York, Oregon, California, one after the other, the dominoes are falling. So you had some forewarning, and rent control is a kind of a precursor to this kind of rent forgiveness. But I think you're going to see some of it. I just don't think that's going to be a widespread nationwide movement, but you're going to see it sporadically. If you have enough reserves, you'll get through it, because I don't think anyone's going to do rent strikes that are 6 months or a year, that as they're talking about. I think that is going to create a crisis that's so bad that cities will pull back on it.
Okay. Let's see. We've got that question is all over. We've got lots of questions that are basically the same like that. Neal, are you still parking your HELOC money safely at home for fear of bank liquidity issues?
I am, yes. All of my entire HELOC is at home. People have been asking me, do you think that it's time to return it? And my answer is no, not because I'm less afraid at this point of time, but I see a lot of opportunity. So in my mind, paying 3.75% on a large HELOC, I'd much rather pay. That's the cost of opportunity. I want to be able to move quickly. That money stays in for at least 6 more months. I think there's a 90% chance I'm going to end up using it on an asset. So, I mean, there's blood in the water. You got to have liquidity when there's blood in the water. And the blood in the water is really coming. It's not here yet, right? So Q3, Q4, the economy's got to lose and loans have to become available. So why put that money back in the bank?
Regarding logistic industrial opportunities, does this mean we import more from China to inventory, or manufacturing comes back to the good old USA?
Might not be either. I mean, in general, if you're not as much of a just-in-time economy, you need twice as much storage simply because you're storing more stuff after it comes in. The two things that you described are separate factors. What I'm talking about is simply us being more prudent with how much we store than before. People learn from every mistake that they made. Creating a just-in-time economy was not a very good idea.
When is the lowest point you advise to buy, and how do we determine it?
No idea.
Magic.
If any of us knew that, we'd be sitting on that beach that Feras is. We'd be owning that beach that Feras is.
I'm not sitting on this beach.
That's right.
Okay, Bay Area. We always get this question: how will the market, specifically Bay Area, be with respect to single-family construction, multifamily? Do you see some opportunity even in recession?
I think the 1 million and above market, in my favorite market in the US that I don't invest in, is going to suffer. I think that we've already seen, my friend Patrick at Compass sends me these reports. We've seen a radical slowdown in inventory and listings above 1 million. And not surprisingly, anything below 800,000 is flying off the shelves. They're not seeing any issues. Inventory is coming in, and demand is pretty high. It's that in-between area might see some slowdown. So for the moment, nothing is going wrong with the Bay Area, simply because so many listings are being pulled that supply is down 70%. How can you possibly have a price decline if supply is down 70%? Obviously, over the next 3 to 4 months, there's going to be an adjustment between what buyers are thinking and what sellers are thinking. And I think that the high-end market in the Bay Area is going to suffer. The low-end, the lower end of the Bay Area market might not, have any issues at all.
So this person's medical background tells them that the normal virus pattern will pulse like anything alive. So they're suggesting that perhaps that it will project a wave-like recession rather than traditional analysis out there. So any commentary about, like, if this goes on and on, like someone has been speculating, does anyone see a wave pattern with the recession?
Yeah, I don't think so.
I think people are going to learn to work with it, is my kind of, we had,
yeah.
And so it becomes part of the norm in terms of, okay, waves, and what does the business world look like?
I see waves in infection counts, but I don't see waves in economic cycles.
Things move too macro. Things don't move in small enough increments that we'll really notice it, I don't think.
For us, this one's for you. What specifically did you do to get better rent collection in May compared to March or April, as you were saying?
Man.
Don't show them your gun, Feras. No, you can't do that on this show.
No, I got to keep it clean. No, I mean, it's creating a win-win situation, right? So right now, evictions can't happen anyways. So the more you can help your tenants and help them find resources, who's hiring, who's not, helping them realize, like, the surprising thing is a lot of tenants didn't think they were going to get a stimulus check. It's like, well, no, you are, and here's the resource, and here's how you can know. So really, we took the approach of, how do you help them help us, right? And really, create that win-win situation. For people that did lose their jobs, right? First we asked them to kind of verify that they did file for unemployment. Did they actually lose their job? Are they trying to game the system? But from then, really figuring out how do we create a win-win? So there's some tenants that we've worked with, right? Some of them aren't going to be able to pay. And, we decided, look, for the next 2 months, we'll, no rent. And we'll kind of put that on the back end and split that across the remainder of your lease. But really, I think a lot of it is just about building community people want to be at. They don't want to leave it to begin with. They don't want to get evicted. They're going to try to figure out how to pay the rent. And then for those that are struggling, how do you help them get the right resources, right? There are a lot of resources out there. Amazon is hiring at thousands of jobs, right? And really, how do you find the resources in your community, in your area, for those tenants to kind of help? And so.
Okay, so I guess adding on to that, which multiple people can chip in though, what are some good alternatives to deal with non-paying tenants given that we can't evict them?
Most of my tenants are military, so I've had no problems.
Good for you. We haven't been so lucky. I think the big thing is talking with them and pushing them to use their deposits. If they absolutely won't do anything else, then they have that deposit. No tenant can say, I don't have my deposit, because you've already got his deposit, right? So at that point, when you're talking with them,
you did the right job screening them and upfront. And getting
So if you have their deposit, I think that's always an option. And most tenants are not blunt enough to say, no, I just want to take advantage of you, right? So when you start talking about taking a piece of their deposit and just modifying their lease, at that point, you're going to start seeing a number of those people work with you.
Here's something. Oh, sorry, go ahead, Feras.
No, I was going to say evictions are going to happen at some point, right? And so people don't want an eviction on their record. So, if they're not gaming the system, for us, it's who's legitimately has a problem, great, let's help them. And who's kind of really just trying to game the system, well, there's also a stick in that case, right? So. Yeah,
I think it's important to point out in the right way to the person that the government has simply suspended evictions. Right. They haven't stopped them. And at some point, your credit is going to be ruined. So if this is a game that you're playing, we can tell you it's not worth it.
And they need a place to live. So more than ever, unless they've got some place to camp with their family or, some couch they can go live on, they've got to protect that and not get evicted.
Let me throw out one more thought for anybody that might have a tenant that they like, that's paid in the past, that is just on hard times right now, and you need to work with. Because the way I kind of see it is, I've said to my property managers, please reach out to all the tenants. I know that tenants are either going to pay or they're not going to pay. There's probably not much I can say to change their mind. Certainly there's some that you kind of point out, well, pay as much as you can, and that will make a difference. But first of all, we've been very fortunate that a lot of our tenants are military, so they have paid. But what I've told my property managers is, if somebody says they can't pay, document the hardship, ask them why they can't, make them justify it. If it's a reasonable response and they're a tenant that's paid well in the past, now's a good time to get a concession. Basically say to that tenant, great, we're gonna either do a forbearance, we'll let you push the rent out for a little while, we'll let you tack it on to the end, but in return, I'd love to get another year on your lease. Let's extend your lease now. If they're a good tenant that in the past has paid, and the only reason they're not paying now is because of their situation, thanks to COVID, now could be a great time to kind of lock them in for an extra year or two in return for you working with them in their situation. And then 6 months when things start to get better, 2 years or 3 years when things start to get better, you basically now have a tenant that's kind of been around a little bit longer.
This one I think is also for you, Jay. I know it's probably a risky time to flip, but what data points should we be monitoring to see if it's more favorable time to strike?
So now is not a good time. If for anybody that needs to ask me if they should be flipping right now, the answer is no. There are some people that can probably get away with it, but those aren't the ones that are asking me that question. What I would say, here's the biggest recommendation for anybody that's flipping. Look at what happened in your market in 2008. Look at what prices did in your market in 2008. That's kind of your, I don't want to say it's the worst case because it could certainly get worse, but it's kind of your benchmark worst case scenario over the next 6 to 12 months, I think. And if what you see is in your market, prices fell 10 or 12 or 14% in 2008, and you're going to be able to pick up a flip that you're going to make 15 or 17 or 20% margins on, well, you've now insulated yourself against loss. If the market does as bad as it did in 2008 and it drops 12 or 14%, but you're making 15 or 20% profit, Worst case, if that happens, you're going to break even. And obviously, if it doesn't drop that much, you make some money. If you're in a market where back in 2008, you saw 20 or 30, or Feras, I was in Atlanta back in 2008, and we saw some 40 and 50% drops in certain markets in Atlanta, I wouldn't be flipping in those markets right now because my margins are probably 15 to 17%. And that means I'm potentially risking 30% on these deals if we see a 2008 type event. So know what happened in your market in 2008, use it as a benchmark. Obviously, it's not guaranteed that that's your worst case, but it's a reasonable benchmark at this point.
Okay, I'm going to combine these two questions. Have you seen more difficulty with renting out units because people are not moving as much? And have you had to depress rents to attract good renters at this time?
For our portfolio, no on both. We've
That's
had
right.
no issue. Our occupancy has gone up because our NTVs, or notice to vacates, a lot of people have withdrawn those notices to vacate. We haven't dropped rents, and nationwide, rents have dropped on Class C by 0.3%, so that's almost a statistically insignificant. And on Class A, they dropped by 0.7%, and both of those numbers, in my mind, are extremely small given the magnitude of what we just went through.
Yeah, we've
That's
had
the same we've seen too.
weekly 4, 5, 6, 7 leases per week coming into our properties, and that's with no concessions and no change in rent. So we're getting the tenants. Feras?
No, it's the exact same thing we've seen. And you have my head spinning this entire call about your comment earlier about maybe people are separating and moving out, and that's maybe a cause for the for the leases. I guess it'd be interesting to think through.
Yeah. Let's see. What are your thoughts on sellers selling their primary house at this time?
Sell if you have to, but why would you want to sell otherwise?
What type of real estate would be best to invest in as a beginner now?
The cheap kind.
Yeah. I'm telling people, if you're new to real estate, there are a whole lot of people out there that I know they're biting at the bit to kind of go out and do a deal. They see other people still doing deals. They're thinking, wow, there's got to be great deals out there. Don't feel that pressure right now. Now's a great time to be preparing, to be saving up cash, to be working on your credit score, to be opening lines of credit, to be building out a business plan, to be reading books, to be watching these types of webinars and town halls. Now's a great time to be working on your business without actually going out and buying properties. I would suggest to anybody that's kind of new at this, wait and see where we kind of land when the lockdown starts to loosen up, and see where we are at that point, and wait for those opportunities to present themselves. Because right now there's just too much uncertainty. This is a tough time for us experienced investors to be making decisions. It's really tough for anybody that's new at this.
So I'm going to combine again a couple of questions. What percentage are you potentially expecting to decline in the real estate market for single family as well as multifamily? Do you believe a 20 to 25% drop in multifamily prices could be possible?
Anything's possible. I think it's extremely unlikely. Multifamily was in a very good place. And it wouldn't drop at all if Fannie and Freddie hadn't imposed these new onerous measures on us and dropped our LTVs in certain markets. But both single family and multifamily are in a much more robust place than they were in 2008 as markets. The sort of investors that are holding those assets are not over leveraged because they've seen a lot of equity gain in the last 7 or 8 years. So their leverage levels are low. They've paid down a lot of their loans. So it's a completely different market. So I see prices dropping simply because there's downward pressure in a number of cases. And actually might drop a little bit more for multifamily because the single family market doesn't have these onerous new requirements of a year's worth of expenses in impounds. So and the single family market also, the lending is more liquid today than the multifamily market. So I think on average, the single family market, I don't see it going, if it declines not more than 5%, multifamily might go down to 10%, but I think it's going to be a shallow down and a quick up.
Yeah, I think we could see risk premiums expand a little bit in the multifamily space. Well, across all asset
All
classes.
commercial, yeah.
Yeah, but I think that's the only risk for multifamily. I don't think, well, I think multifamily is better positioned than nearly any other asset class right now. Single family, I don't have, I think anybody that tells you they can predict what's going to happen is just making stuff up. So my guess is no better than anybody else's.
Yeah, and maybe to add to that too, just in terms of what we are seeing, right? So when we talk to brokers daily, right? I know in general, in terms of deals that were going on before COVID that didn't close, right? Those buyers have been able to negotiate, on a, take an example, one of the two examples, like on a $17, $18 million deal, they did get a $1 million discount, right? So that kind of helps give you some perspective. That's like what, 7%? And on deals that we're looking at, right, there's one deal that we're looking at very closely that they were asking kind of 92, 93,000 a door pre-COVID, but now the opportunity is really low 80s, right? So then that's really, if you kind of do the math, that's a 20%. But that's a very unique case, right? But I kind of agree with Neal, maybe up to 10%. What's more interesting to me is what are you going to model for your year one and year two economic occupancy, right? More than the price that you're buying it at. Because again, There's a lot of ways to mitigate your risk of losing the deal, but the more interesting, are you actually going to make any money on that deal, right?
Yeah,
depending on how much money you bring to the table.
We had a $22 million deal in Houston under contract at the beginning of March. We were getting ready to go down there to do inspections, and we backed out, and we're at about 19.5 on that deal right now. So it's
there you go.
Yeah,
there you go, right around the 10% mark.
Yep.
Yeah, I think that there's going to be some deals that are going to go beyond 10%, but as the market, as lending loosens up, which it's already beginning to loosen up, we see somewhat of a loosening up effect. You're going to see 5, you're going to see 10. I mean, but the 2008 scenario requires there to be lots of shutdowns. It requires there to be a massive, cascade effect. I mean, you're definitely talking way beyond the worst case scenario at this point. This is a fairly strong economy, and I think that its ability to bounce back is certainly better than it was in 2008.
I have to say, the importance of sheltering in place has to be on people's minds. So when we went back to 2008, there were people that went home to their parents and they were working a job and they might not have been able to afford much, right? These days, when people are thinking of going home to their parents, they have to think, if I'm still working a job, I could be exposing my parents of the virus because I'm out there working in the world. So
Phenomenal
it's a very different thought process to be sheltering at home with your, parents who might be in a risk category than it was before. And other people might be separating from roommates that were working jobs that were risky. And because they have asthma or these things, they want to be in a studio or a 1-bedroom because they can no longer, they don't want to risk their own health by having, being in a 3-bedroom. So
perfect point, Anna. Very good.
Why we're seeing more leasing.
Yeah, that could be. Okay, this one's right up your alley, Neal. Please talk about COVID-19 impact on population density trends, as well as adoption of autonomous vehicles.
So I'd love to tell you that this is going to lead to a spike in autonomous vehicles. We're just not there yet. The technology is not there yet. We're still about 3 to 4 years away from there being any reasonable priced adoption of autonomous vehicles, perhaps 3 years from a taxi level, and maybe 5 to 6 years for private vehicles. So at the moment, if COVID had arrived in 2023, that would have given a massive boost to the autonomous vehicle industry, but I think they're still in beta phase. Population density, we've seen some indicators. Sale of rural houses all across the United States is up, like tremendously up, like huge numbers. But we've seen these kinds of small impacts in recessions before. After 2001, after 9/11, the number of preppers went up crazy, like 3x for a year or 2 years, and then it dropped back down to the same level. So I think that from a density perspective, if we get to a vaccine within the next 12 months, you're not going to see a significant impact, because there is a current long-term movement to increase density, to densify.
Yeah.
So I think that you are going to see a movement to reduce density. People will want to rent in lower density units, but I think that lasts for a year, maybe 2 years. I don't think it's a permanent thing. Now, if these lockdowns go on for more than 2 years, I think society could simply change. in that case, you could see a decrease in density. But I think the bigger movement is to increase density, not to decrease density. Scott, what do you think? Sorry, Jay, sorry.
No, I 100% agree. I think that we always see some small shifts, some typical shifts, and we have no reason at this point to think that it's going to be any more systemic than it typically is. And so from the autonomous vehicle standpoint, I think if Elon Musk has any more of his major meltdowns, honestly, that could impact the industry more than COVID-19. I mean, it's getting a little scary that Tesla's kind of getting knocked off track.
Yeah.
Okay, your thoughts on affordable housing development. So let's open it up to new construction of of affordable housing, or Section 8, let's just say, as well as buying value add Section 8. Is that a good thing to do right now?
If you were doing Section 8 development before, if you were doing affordable housing, you've got some tailwinds there. But if you weren't doing affordable housing, I don't think that is a business plan. Because I think that, yes, right now having Section 8 tenants in your property is good. And maybe it's good for the next 6 months. Maybe it's good until the end of the year. But then the premise is going to go back to market tenants being better. And so I don't think that anyone should change their business plan to go from market tenants to Section 8 tenants simply because of COVID, because I think this is a 6 to 9 month impact, and a development leases up 18 months from today.
That's true.
So, right, if your development was coming to market today and you could somehow finagle that by talking with the city, sure, that's fine. You're looking for a short-term benefit. I think that affordable housing is a very specific skill. I can tell you it's incredibly difficult to make affordable housing work. And some of those people are making 15-year investments because in 15 years their property pivots from affordable housing to market. Study that market well, but I don't think that there's a lot of reasons to go from market to Section 8. I mean, I am not allowing any Section 8 people more than usual into my property, and I want to ask Feras, I mean, have you thought about letting in Section 8 people at this point?
No, I mean, some of our properties, we adopted them. They had some, I mean, very minimal, right? We don't have any. I mean, a handful of people, and we're not changing that. We're not going more one direction or the other, because again, the market as it is today is fine, right? It's working out well. But to your point, I think whenever me and you say affordable rent, it means something different than maybe what people in the audience are saying, right? So we're specifically talking about Section 8 government subsidized, right. But I do think that the opportunity, and I don't think it's changing, it might even work in its favor, but in terms of being able to build really affordable market rate rentals, right? That is still an interesting proposition if you can do the pricing correctly.
I just don't see it. I keep waiting for that one magic developer that is going to do both affordable and market rate. I fail to find, I mean, I have not found a single scale developer that can do both, because today cost of construction is, I mean, it starts at $160,000, $170,000 a unit and then goes up from there if you want to amenitize in any way. So I'm still waiting for that one magic developer that can actually put it all together and do affordable and market rate at the same time. It seems like if you want to go affordable, you need subsidies. And if anyone knows of people that are doing it at $110,000 a unit or $100,000 a unit, which is really what's needed to do affordable, please send them our way.
Yeah, absolutely. Okay, so we've reached the time when I am going to have each of our panelists look over the questions and choose one, or you can do a mashup of a couple of them to finish your panel with.
Mm.
Do, 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 do. And when you've got your question, raise your hand, or I'll call out one of you if no one raises their hand.
All right, I'll answer one just to get this going, because the question is, can the downturn in retail and office real estate spill over to the multifamily real estate? I mean, anything is possible. I think what's interesting is to go back to Jay's point about how do you convert one asset class to the other, right? One thing that we've been tossing this idea around, I don't have any data to back it up, but specifically in Houston, right, which is where we're based, office space has already had issues. And then now with what's going on with COVID, plus what's going on with oil, right, office space, I mean, it's going to be all over the place. And I think there might be an interesting opportunity to buy that for kind of one of two plays. One is buying it as kind of an individual investor as us. We're not a big REIT, right? Our goal is not to just to show the highest price per square foot, but our goal is to actually make money on the deal. So we can lease at a more economic or a more attractive price point is kind of one play. But I think the other play that's interesting is really, is there an opportunity to convert some of this office space into multifamily, right? And so now if you're increasing the supply by doing that, well, obviously you're going to have an impact on multifamily. And so I think that's kind of some of the macroeconomics are some of the interesting things to think about.
Yeah, but it's hard though. I've looked at it. It's hard to convert office to multifamily. It ends up being very expensive. It's easier to convert offices to like medical offices. So if I was buying office today because there was a city that wasn't doing well, I'd go the medical office route because I can still use the same internal structure and not move too many walls. So I'm going to take an easy one. Are you avoiding acquiring properties in rent-controlled cities? Hell yeah. I definitely
have been.
This is going to get worse. I mean, all this talk about, no rent for a year. I mean, that's what Chicago is looking at. No rent for a year. Imagine what that does to the ecosystem. It's nuts.
That was softball.
What it does to the landlord.
Yeah,
I mean, as landlords, because I think a lot of people talk about the rent side, but it doesn't mean taxes have stopped for the landlord. It doesn't mean the mortgage payment has stopped for the landlord. And so I don't see it happening without some sort of relief on the other side of it.
Yeah, there's got to be. Otherwise, it's going to be a foreclosure, and those people will lose where they're living. So it kind of does make sense when you think it through. Okay, Jay, you're up.
Let's see. I have two here. I'm going to start with this one because I'm curious if you guys have any insight here. Do you see the Houston market strong for multifamily? So that's where I had two properties. I had 450 units under contract in March that we're kind of putting off and trying to decide if we're going to move forward on in Houston. I think multifamily, again, as I think we've all said, is going to remain strong. It's going to be pretty resilient. Houston, though, is a scary market. It's the hub of oil in the United States, and what we've seen with oil over the last couple of weeks is scary. And there have already been a number of bankruptcies in the energy sector in Houston. And so we're on the fence if we're going to move forward on these deals that we have or could have again under contract in Houston. So I'm curious if the three of you know anything about Houston or have any thoughts there specifically.
Well, we're doing projects there, so I'm gonna jump into this. I agree. I think Houston is going to have a lot of pain, but in my mind, that's a year's worth of pain. One of the nice things about oil is like banks. When banks go out of business, somebody buys them. In the same way, when oil companies go out of business, whether they're upstream or downstream, someone always buys them because there's value to the wells and there's value to the equipment. So there's going to be pain for a while. People get laid off. And I think Houston's going to have roughly 100,000 more people get laid off than any other American city typically would be. That's of the same size. 8% of Houston's economy is oil and oil related. So I think you're going to see a lot of hits there. But before COVID happened, Houston was ranked #1 in the US for long-term multifamily growth by both CoStar and Reese. Yep. So they were saying 2022, 2023, that's where you want to be because population growth was phenomenal, right? And is phenomenal at this point in time. So in my mind, short-term pain, but if you can get through it, Houston remains a really, really strong economy.
Yeah, I just want to add on to that before Feras jumps in, because I know you got something to say, but besides oil, you have the Texas Medical Center, which is the largest medical center in the nation. And if we're talking about healthcare and places that are going to be contributing to solutions, I think we have to be looking at places like the Texas Medical Center, and that is in the heart of Houston.
Yep.
Yeah. So I live in Houston, obviously, and our office is in the energy corridor, and I'm right here sitting here in the energy corridor. So I have a good pulse on it. And so we left Houston several years ago because the price points are too high. It was getting, it was just pricing for multifamily just wasn't making sense, right? And that's kind of what got us to Atlanta to begin with. Now, with kind of a couple of the comments that everyone said, I think pricing will drop, but really living in the area, there has not been much of a transition yet, right? Because a lot of the companies here are still, they still produce oil, right? Now, yes, they're not out there drilling. Yes, places like Midland and Odessa are getting slaughtered. Right. But in the end of the day, Houston still is the hub. Yes, there will be layoffs. Yes, there will be an impact. But I think really in my mind, I think that's just going to adjust pricing back down to where it should have been, because I felt like it's been too high. And then you've seen, to your point about the medical center, Houston is a massive, massive city, from medical center to NASA to oil to everything else in between. And so it is an important thing. I don't see that being like, hey, the medical center is going to triple in size, right? I think there's, I think it's going to be what it is. It's kind of constrained really, in terms of where it is located in Houston. And so I think, that will help. But I think Houston's grown as a city, right? We're a lot more resilient than we were. We saw what happened in the last oil, the recent oil crash in 2015-16, right? Houston kind of did a pretty good job of it. And to Neal's point, it's been interesting to see the changes in Houston. And I was talking to my partner about this because I think I know Houston better than he does. I go out to all the different pockets, and you are starting to see this hipster trend setting kind of experience starting to show up in pockets of Houston. And I'm just like, wow, this was never here. And so, maybe my big answer is I think Houston's price is going to adjust down to where it should have been. And I think the outlook is still attractive, right? It's not a city that I'm just like, man, this city's population is going to half in the next 20 years, right? And what does that do? So
what do you guys?
Hopefully we'll buy a deal in Houston this year.
George Brew is saying, let me know if you drop the deal. I'll take it in Houston. I think it's a great market.
I like that, George.
So what do you guys and gal think about, so one potential impact of this whole pandemic and a shift we may see is a backlash against immigrants. And we're already starting to see borders shut down. And depending on what happens in the election in November, depending on what happens with China, depending on what happens with the pandemic, it's very possible that we could see a tremendous reduction in both legal and illegal immigration. And that could certainly hurt population growth in certain cities. So definitely something else to just everybody should be keeping in mind, these types of external factors that we might otherwise not be thinking about.
Absolutely. I do think that that's heavily dependent on what happens in November in the elections, because we've seen that if a Democrat comes into power, that is going to die down. But I think if Trump wins again, he's going to double down on that. And I think that you're going to see a very large, a stunning decrease in the number of both authorized and unauthorized immigrants. And I think that affects some of these gateway cities, right? Now, Houston's less of a gateway city than New York or Los Angeles, but still, I think there's a significant impact.
Somebody had a question for me. Any specific financing strategies to accumulate some dry powder? Just the basics. So sell off any assets that you're not comfortable holding for the next 5 years. If we do see a downturn, it's not going to be a forever downturn. Things will come back. But if you're not comfortable holding something for 2, 3, 5 years, now's a good time to sell it if you can still get out at a good price. Open up lines of credit. And maybe even, depending on where things head, maybe even start to take some of that money out and stick it under a mattress or in a bank account. We've already seen some reductions in closing of credit lines. I expect that to loosen up. I think the lending markets had some liquidity issues over the last 6 weeks that will ease up. So I don't see that as a big risk short term. And the other thing I'm telling people is now's a great time. I'm not a huge fan of partners in general, but for newer investors, now's a great time to kind of build a team, because if there are opportunities, there could be a lot of opportunities, and having a strong team, somebody that has capital, somebody that has some experience, somebody that's willing to put in the work, somebody that can manage, somebody whatever, just building a diverse team where everybody has complementary skills during a downturn when there could be a lot of opportunities, good opportunities. Having a team and having good partners that you trust and have complementary skills could be something that makes sense. And again, I'm typically not a fan of running into partnerships, but I'll make an exception in this case.
We think multifamily is a team sport, so we definitely agree with the partnering aspect.
We have partners in all of our projects, right? So I've been involved in 21 of them, have had partners in all of them, and luckily have not had a big horror story to share on those projects. So we're about 10 minutes beyond our wrap-up time. So thank you to the 350 of you that are still here. Boy, you've got a tolerance for this kind of information. So thank you all for coming. I want to thank our panelists. Jay, thank you for your thoughts on the economy. Feras, thank you for the insight that you provided on how multifamily is doing today. And Anna, as always, you're coming up with some home runs on your own as well. So thanks so much for putting this together one more time. And we'll be back with Town Hall number 6 in about 2 weeks. Thank you all, and have a wonderful rest of your day. Bye-bye.
Stay safe.